Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
Like I said before, crazy last couple of weeks. But the market's up over the last 30 days. So I guess that's progress.
I know this is the second time through, but you're calling the market bottom? Is that what we're doing here?
I'll never do such a thing. No, I think there could get worse before it gets better. There's just not. We talked about this before. There's not enough good news out there. Except that can inflation get any worse?
I guess that's the only good news right now is, can it get any worse?
Yeah, I mean, let's see. June's data was 9.1%. CPI data was 9.1% year over year, 5.9% month over month. That's high.
And the expectations for CPI year over year was 8.8, so it came in even above the already bad expectations.
Yeah. And the White House knew about it. They were getting ahead of it on Monday. So it's so bad that maybe it's good, right? So everyone's looking for that peak in inflation as a a marker for when things are starting to look a little better. Maybe bad as good, right? And that didn't pick up any of the data that really any of the late June data, which was kind of commodity prices turned over really, really hard. That includes oil and lumber and grains, and pretty much every commodity price was down in by the end of the month. So that should get picked up in July's numbers, you'd think, right? And in fact, we Ophir Gottlieb, who's kind of like he's a super smart guy, more on the high growth side of investing, but he does a webinar every month or two. And he had a bunch of data that outlined how inflation was turning over pretty hard. And trucking data, meaning the cost of shipping is going down now, finally. So things are turning over pretty hard. Inventories are really high. In fact, I read an article that these liquidators, are just so the Targets and J. Crews of the world, whatever. When they have excess inventory, they'll sell it to liquidators, who then sell it to Marshalls or TJ Maxx or whatever it is, right? Well, they're not even getting this merchandise is not even getting to the store now. It's being turned right to liquidators, meaning all of these stores are overstocked. Their inventories are really high already. That's usually a sign of future decreasing prices. And apparel was a big component of CPI this past month. I think that should get better.
I think the numbers that just the general public are looking for, and I know we talked a lot about all the different commodity prices, but the one commodity price as a headline would be the gas and oil. So we've already started to see a reversal in gas prices, although it's not a lot at this point. I can't believe I went to the pump the other day and I think it was $4.49 to fill up my car, and I'm thinking to myself, like, this is great. It's under $4.50, just to fill up my car right now. So I think that once the gas prices start to trend down even further, that will give people a lot of optimism that we have peaked and that we are primed for a reversal. As far as the stock markets, we know the stock market's going to rebound well before the economy does. Not saying that we're in a recession right now. Obviously, unemployment would have to almost double from here. But if people were worried about a recession, a lot would have to happen from right now.
Yeah, we talked about this last time too. That there's only so many people predicting a recession that you feel like there's this like people just they want it to happen now because they don't want to be wrong about it. And there very well could be a recession called, 2 quarters of negative GDP plus a couple other things that have to happen. But the jobs data this past month still look pretty good. So I just don't know. I feel like a recession is when people lose jobs and can't maintain lifestyle. And maybe inflation's enough to pull people down. But if it turns over, depending upon how fast it turns over, we're in a pretty decent place from a job standpoint, from a total income standpoint. I just wonder.
I was going to say, I guess the aim from the Federal Reserve is not to only tame inflation, right, but to start to slow down economic activity to a certain degree. They don't want to have to do that, but unfortunately, they have to kind of go ahead and try to slow down economic activity to tame inflation. And we want to say, oh, we're going to have a soft landing and not put the economy into recession. We'll see. Time will tell if that's actually the case. Some people actually believe we're already in a recession without the 2 negative quarters of GDP. But I think one thing I was actually hearing on the news the other day is that bank deposits have decreased substantially, and that is a indicator that the Federal Reserve is doing its job, right? That it is doing something and it is working its way through the system. If bank deposits are slowing down so significantly, then raising interest rates has had an impact already. Although it might not trickle down to certain parts of the market that people are focused on, I think that it's already starting to do something more than some people already presume that it has.
But here's the problem with what the Fed can do. They only have so many tools, right? So they have a limited toolkit. They can only impact the demand side of inflation, right? They can only, to your point, which is they can only curtail spending and by increasing rates, et cetera. But they can't affect the supply side. And so I guess, and look, these guys are all super smart who work at the Fed, so the Federal Reserve. So I'm not really worried about it, but I think people get caught up that this is all demand side, and it's just not. There's been disruptions through COVID that are just so dramatic that the Fed can only do so much, and I just worry they overshoot. And one of their mandates of the Fed is to maintain high employment or low unemployment, right? But the nature of increasing rates can lead to job loss eventually. It hasn't happened yet, but could. So there's this kind of dilemma that eventually they go too far. People the companies start laying people off. They have to pause and reverse course, and then try to bring back jobs, which is one of their mandates, which they have to do. So
I think that's something they're
opposition.
I think that's something they're trying to be careful of, and I think the Federal Reserve has learned several times in the past. I think like 2018, where they tighten a little bit too quickly and then kind of have to reverse course. So I think they're looking at this and saying, we want to take a step back and watch the data come in. But that was a couple months ago when they were saying things were still transitory, or 6 or 8 months ago. So now I think they kind of lost that luxury of reading the data, and they're already kind of priced in, and people have already boxed them into making a certain amount of rate hikes for this year. Luckily, me and you were talking about this before the show, was that they're going to be able to see the CPI reads for both July and August, because the Federal Reserve, most people think they're going to hike at least 75 basis points in July, but they don't meet in August. So they have the luxury till not doing anything till September, and they can actually sit back and say, are these prices rolling over, and is inflation altogether rolling over?
Yeah, that'll be interesting to see. Definitely. I just had a train of thought and I forgot it. Oh, I was going to say I'm more of a PCE guy. I'm on PCE camp, which is what the Fed's looking at anyway. It's what PCE is the only difference between PCE and CPI is PCE is what people are actually spending their money on. CPI is just a measurement of the cost of a basket of goods at a particular moment in time. So PCE is more a better reflection of what. An example is, what if all of a sudden the cost of a loaf of bread went up to $1 million? That would get captured in CPI, but no one would buy bread. They buy pasta or rice or something else, some other potatoes, whatever it is, and that wouldn't get reflected in PCE. To me, it's a better measurement. So that data obviously will come out soon, and it won't be good either, obviously. But I don't know. I feel like this feels like a top to me. I don't know. I'm not making a
I think
prediction,
everybody's hoping that you're right.
I can't imagine with commodity prices where they are that it can go any higher. But this could be famous last words.
I just feel like and I think it's a nice transition out of this, but I think that, you're talking about COVID, like supply side and all the things that a factor in. It's kind of been the perfect storm where I know we've talked about some previous podcasts, but the geopolitical tensions, and you have Russia, Ukraine, and Taiwan potentially, and there's been a lot of different factors that have kind of gone into where we are today.
There's the Ophir Gottlieb who again on his presentation, and he tweeted about it too, so it's all public knowledge. You don't have to be behind his paywall or whatever to get access to it. But he made a really good analogy, which was that the markets, and oftentimes they mimic nature. So people think that the market's going up and down, or the probability of a bad market environment is almost like a coin flip. There's a probability on it, right? And there is initially. But there's, I forget what it's called, but there's the other concept that one event can lead to a cluster of additional events. And he gives the example of an earthquake. That's the analogy in nature, that if there's an earthquake, first of all, there's an original probability of an earthquake or not an earthquake, right? But if there is an earthquake, the probability of another one within a shortened amount of time is much, much higher. So it's not a coin flip anymore, right? It has its own new probable outcome. And the problem when we get into negative market environments is there's this clustering of bad news, right? We had it when in the financial crisis, Lehman Brothers went out of business, declared bankruptcy. Whoever was holding their debt or their notes also had problems. And then whoever held their notes, that company's notes had problems, and so on down the kind of the domino chain there. And so bad news, there's a higher probability today of bad news than there was back when, back in January, February. And that's the concern for investors is well, what if China invades Taiwan? There's all these things that can still happen that are now more likely to happen because Russia invaded Ukraine and so all the other events that happened before it. And so that's the challenge with investing is that when things get bad, they tend to get dragged out. It doesn't happen like COVID happened. Like it was bad for a few weeks or 5 weeks, and then the market, and then everything kind of rushed back. After that, the normal recessionary environment potential, like we're kind of in, is more normal, where there's this cluster of bad news. That's kind of where we are, and eventually it'll stop, and it'll turn positive. And then there's a cluster of positive news. There's a momentum the other way. And that's when you want to be, that's why you need to be invested through it, is that you don't want to miss the cluster of good news.
I think to kind of close out this thought, that's what Jeremy Siegel, he's the professor at the school of, at Wharton School of Business over University of Pennsylvania, was saying that he wants to be long the market the day that the Federal Reserve comes out and says, we think we've done our job to a certain degree to tighten financial conditions up to where we believe is a neutral rate, and we're going to let inflation do its thing. And by do its thing, I mean it's starting to roll over. So we don't want to hike too aggressively where we're over tightening and putting the economy into a recessionary period. So I think that most people like Jeremy Siegel, Jim Cramer, Tom Lee, a lot of the big time media personalities are coming out and saying that they're thinking with inflation starting to peak and roll over and a lot of these commodity prices coming down, that could be sooner rather than later. And I think all of us are hoping that's the case.
Yeah, definitely. Definitely. That would be a piece of good news, right? That would be that first piece of good news. Now that can be thrown off by China invading Taiwan, but at least we have a chance of good news on the horizon, which is 30 days away. We can make it 30 days. You know what? I was talking to a client, I think it was today, and they were telling me about their friend whose advisor somehow got out of the market in February, or whenever it was, earlier this year. And I said, that's great for your friend. It seems like good timing. When are they getting back in? What's the plan? And she's like, well, I don't know. I don't know when they get back in. So that's part of the problem of getting back in. I think the worst thing to happen is for a professional, someone who does what we do for a living, to guess the top or guess the bottom. Because once they do it the first time, they've now convinced themselves probably that they know something that everybody else doesn't, right? And wouldn't you be more inclined to try to play that guessing game again if you got it right once? And so there were alarm bells going off back in March of last year, 2021. There were some analysts, we use one of them, that was calling for a market top back then. We don't act on things like that, of course. But what if you could have gotten out then, right? You would have missed one of the best years in the market, in the last 20 years. And so not every signal is the right signal. So my point is that a lot of times, if you've gotten out of the top or got an in right at the bottom, it was accidental. And it sounds harsh to say that, but that's what it is. And I would argue it's detrimental to the future advice you'd give to your clients. That's my thought process on it. And that's the conversation I had with a client. Like, gosh, I feel bad because that's probably now going to be ingrained to that person's memory that they can pick that moment, that seismic shift. And it's just, as you know, and I know, and everybody else in the office knows, it's just nearly impossible.
And I think the problem, there's a lot of different issues with that, but one of them is when the market does start to recover. I used to have this graphic. It was like that if you miss out on the 10 best days every year in the market or over like a decade or whatever it was, and a lot of those best performing days are when the market starts to hit that bottom. So when they start reversing course, you're going to get a bunch of strong performance from the market as it spikes back up. And if you miss those, let's call it 10 best days in market recovery, your returns are cut in half or cut in a third over the long run. So it's just another way to say remain invested, stay diversified, everything that we kind of preach here.
We write a lot and do a lot of communicating to our clients. And I wrote a piece, it was during COVID, because it was about prior market downturns. And I referenced the financial crisis, just to your point. If you had missed the first 20 days of the recovery, it would have extended you missed the first 20, you got in that 20th day. It would have extended your recovery by an additional year. So it's just so, and that's just 20 days. It might have been less than that, but in my mind, I feel like it's 20 days. Those 20 days, that decision to try to time things, it cost you a year's worth of recovery. That's meaningful, especially from a retirement perspective.
You just have to be so precise of when you get back in. You have to be like exactly right. And that's almost impossible to do.
Yeah, it really is. And I don't think oftentimes our job is not, we're not market timers, right? We can lean portfolios certain directions and try to gain some alpha from that perspective, but staying the course is the easiest way to make money over time. Part of our job, though, is really just to be the intermediary between what the current market conditions are and someone's bad decision, right? Like we're the buffer there. And so it's really part of our job, especially in environments like this, is to really help people understand that these things happen. It's part of a healthy market environment. Volatility is the reason there's outsized returns over time. And I'm not going to let you make a bad decision around your investment strategy. Anyway, that got me heated a little bit, but I was looking at our next topic because this guy on LinkedIn got me heated. And you know me, that's hard to do. It was just this post on LinkedIn, and I'm curious to hear what your thoughts are on it. But it was specifically about Bitcoin. I'm not a Bitcoin max. Look, I think it's a game changing technology. I think blockchain itself is game changing, and Bitcoin's the original. It's the OG of cryptocurrencies, right?
Calling yourself not a Bitcoin maxi is debatable, right? You are a pretty big Bitcoin enthusiast. Let's just preface the conversation with that.
Fine, all right. But the comment was that Bitcoin doesn't represent anything. There is no value. There's no earnings. There's no dividends. There's no capital expenditures, none of that stuff. So it shouldn't be part of your portfolio. And go for it if you want to, is kind of his message. But it's probably going to end badly for you. And to me, it wasn't about Bitcoin necessarily. That was part of it. It was more about, I feel like investment advisors they speak of what they know, and that's it. They don't understand that. I shouldn't say they, in generalize everybody, but some folks don't understand that every decision we make is a value-based decision. Like literally every decision we make, some of them are tiny, they're minute, but some of them are more obvious. And one of the examples I gave in the LinkedIn post was, look, if you choose to go golfing with your buddies on a Saturday morning, you're valuing friendship, you're valuing the outdoors, fresh air, whatever it is, over your family in that moment. And it's harsh, but that's the truth. You've put more value in that golfing, the over your family at that moment. Or I use the example of sports cards. Like if you buy a Bryce Harper rookie card, you're not buying it for the value of that cardboard and thinking that cardboard, which is worthless, is going to appreciate over time. It's not, right? You're buying it for what that picture represents, not only to you, but to other collectors, right? So there's this embedded value out there that we don't talk about a lot. Same thing with you buy or lease a car because you value mobility, right? Your ability to get places and faster than walking or riding a bike, right? Or you buy a phone or computer for access to the internet for information. That's a commodity also. But how do you value mobility, and how do you value information? How do you? There's no exchange for that, right? So that's kind of my point was, well, let's start at the beginning where everything's an investment for us, right? Whether it's for mobility or information or time with our friends, it's all an investment and at the sacrifice of something else. And so for Bitcoin, how I brought this kind of back to Bitcoin was Bitcoin represented the most efficient form of currency. That was the goal, right? I'm not saying it is. I'm just saying that was the goal of Bitcoin. The efficient form of currency that doesn't erode its value because you can't create more supply of Bitcoin. That was the original concept. And there's a whole white paper. It's not very long. I would encourage folks to read the white paper about it. But it was, I forget the guy's name now. Oh, man. Breedlove. His last name is Breedlove. It's an odd last name. And he is a Bitcoin maxi, so I will preface it with that. But he said, Bitcoin is not an internet application like MySpace. It is the internet. It's not the Model T. It's the freeway. And so the question I posed was, well, what's the value of the internet? I mean, it's invaluable.
Isn't it how other people's value it as well? Like that's what makes it valuable, is that so many people find it so valuable to their daily life that it creates it to have its own value.
Right. Yeah. And yes, there are instances in history, like tulip mania and stuff like that, where for whatever reason there became this hunger for buying tulips. And maybe that happens again with Bitcoin. I don't know, but to me, I see that there's enough value there, and on top of that, we value things all the time that we don't choose to put a price tag on, right? So I just wonder if there be, would we say, do we value a currency that doesn't erode based on inflationary environments? If take Bitcoin out of the equation, if you had that currency and I could hand that to you and we could use that, I think everyone would say there's value in that.
Yeah,
right?
I think something that isn't altered by central bank manipulation through interest rates. I think everybody's on board with the thought of that, but not everybody's on board with Bitcoin as another currency, right? So Bitcoin,
Yeah.
I believe, as a technology and application is here to stay. I think that's pretty apparent that blockchain technology has already worked its way into several different industries, and that's here to stay. But Bitcoin as a currency is a little bit more debatable. But right now, I think even though it's kind of trended in line with the market, which is been pretty rough over the last few months, and Bitcoin's way down. But you're right. If somebody were to say, here is an alternative form of currency that's not manipulated by central banks, therefore isn't susceptible to inflation, everybody would say, yeah, this is the future. But just because it's a digital currency, people, and this was a little bit before my time, but when everybody was debating the internet, I was too young for that. Not everybody was on board with the internet and didn't understand it. So it kind of reminds me of just people debating the internet back and forth is now debating Bitcoin. I hope that Bitcoin has a future somewhat similar to the internet, and if enough people value something, I think there's going to be a place in for it in the future.
Yeah, there's just too much. There's just too much now from an industry perspective around that's built on blockchain. And I've come back around to the idea that Bitcoin might be used as a currency in the future. I was kind of moving away from that and looking at it more as a store of value. But there's so many. We talked about this before. There's going to be a company that comes along that makes it instantaneous to convert your Bitcoin to whatever currency in whatever country you're in. It's already happened. So that technology, obviously, we're not that smart. Someone had already come up with that idea and implemented it. But now there's ATMs now that you can take cash out based on your Bitcoin balance, to cash out in whatever denomination or currency that you're of the country that you're in. So I'm coming back around to the idea that maybe it is an option for currency in the future because it represents what a currency should be, a value that holds its a representation of an asset that holds value. And look, it fluctuates up and down and up and down because, to your point, it's like the internet in the early days. You're in, you're out. They put my information on here. I don't want people to see my information. I'm not going to put my payment information on there. Everyone's going to have it. There's all this skepticism around it, and I get that. But my reaction to it was not necessarily Bitcoin's the way to go, but the advice was based on the wrong concept of value. That was my takeaway, and we have to start seeing the world as it is, that everything is a value-based decision, including those people that believe in Bitcoin, and not to be surprised that based on the idea of Bitcoin that people value it. Anyway,
we should move on to personal
let me
finance.
get your article.
Or my article.
Let's get to your article. Yeah, Tim. Let's. I thought you wrote an interesting article this week, and I thought you could talk about that.
Yeah. So, like everybody else, our business and the way that I was building my business was impacted by COVID. So I'm not any different than anybody else who was in the same position. But being in our industry and really in sales, for somebody who's trying to build their financial advisory practice from the ground up, everything kind of came to a screeching halt in March of 2020. So, at that current time, I was with a larger company, and they nobody knew what was happening in the early days of COVID. They said, take a step back, kind of just hang out, basically brought all of our prospecting to a halt. And it really got me thinking, well, if this is going to be the new normal, I have to figure out a way to continue to build my business. So the market's down, we're not prospecting. I'm just starting my career in the first 10 years of my career, and now I have to kind of rethink my game plan as far as how am I going to bring in clients, how I'm going to gain trust of clients in a in a world where we're not face to face with prospects anymore. So I wrote an article on how COVID changed my business, how first impressions are crucial, and how to replace winning those first impressions over things like Zoom and different meeting tools, web-based meeting tools that we're now all using, whether it's Zoom or any other software. But I used to be traveling a few days a week to large corporations, meeting with employees, shaking their hand. And that is the way, in our industry at least, that it was kind of laid out. This is the step that you have to do to go and gain somebody's trust. They meet you in person, they shake your hand, you talk to them for 30, 40 minutes, whatever it is, and you meet with them a few times, and then they become a client. Once that all changed, I had to come up with a new game plan of how do I set a really good first impression through video conferencing. And I think that the first 2 minutes are extremely crucial, whether that's in person or over Zoom. But I think it's even more crucial over Zoom because they don't have the ability to shake your hand or, personalize it where you're sitting in the lobby of their company, or there's just a different feel when you're face to face with somebody. So I always try to, and I know we talked about this the other day, but asking really good questions and being a really good listener, but really just kind of opening up and asking a couple questions at the start to get the prospect talking. So the more that I think that they talk from the start, the more likely they are to have a successful meeting with you. And I think that's one of the tips I would recommend to folks who have struggled with this, whatever industry you're in, is that just asking a few questions and relating to them from the very start in the first 2 minutes can kind of set up how the rest of the meeting goes. So a few things, and I'll kind of just mention a few things that I think worked really well now that normal prospecting was somewhat for some period of time. And now it's coming back to be a little bit more normal. But I think for a period of time, things like email campaigns and doing targeted prospecting for company plans, talking to clients more, because you can still pick up the phone and talk to your clients, even if, they're working from home, and, just identifying different opportunities through, your client base and email campaigns, because you're not doing in-person seminars anymore. You now have to rely on different networks that you can tap into. And I think all in all, replacing the handshake was difficult. Meeting face-to-face, replacing that was difficult. But I do think that now it's actually had a lot of added positives for my business, where it's freed up a lot of time, where now I'm not on the road 2-3 days a week. I'm not sitting in traffic. I'm not, getting blown off, because that does happen to everybody. And now you're wasting 3 hours out of the office when somebody doesn't show up to a meeting. And all of that time is now spent writing blogs, doing podcasts, things that are actually fueling growth to my business, email campaigns, thinking about different client gifts. I think it's all really, really valuable.
Yeah, and I think, you've done a great job with all this. And the big component is, I'm going to ask you about the 80-20 rule in a second. But you got really targeted. And I think that's a good lesson for anybody who's a financial advisor, but especially those folks that are building, kind of in the early stages of building a business, is you feel like you have to be really generalized and kind of have this large net out there, right? But success comes in being targeted, because you can get really good and know those folks really well, right? So you're talking about targeted email campaigns. I know what they were. They were really specific to that company's retirement package or plan, and the lingo that kind of went with it, and the health benefits and all that stuff. And so if you can become an expert in whatever niche you're trying to target, I think that goes a much further way than spreading yourself thin across a bunch of different folks. And you've started to reap the benefits of that over time. And I think the other thing you did really well was you developed relationships with your clients that were then willing to be your follow-up to those other communications, to say, hey, did you see Tim's email? He's my financial advisor. You should be talking to him. He's the expert here at this company. And that's really helped you. But I wanted to ask you about the 80-20 rule, because I think that kind of follows on to our conversation from last episode. Tell me about that.
Yeah. So the 80-20 rule is like 80% of your time is going to be spent on things that don't generally drive business, but it's the 20% of your time that you actually spend on what you just alluded to, was targeting certain companies that's really going to fuel your business. So now let's kind of flip the switch. And I think that with all that different time being spent now in the office, I kind of want to spend more of my time on the 20% that actually is fueling growth in my business.
Yeah, gotcha. And I think these targeted ways of marketing are the future in this business. I think podcasts, they're not necessarily podcasts, but some sort of social media presence is really important. And the ability to stick with it. I think whether you think or not, Tim, I think COVID, I wonder how long it would have taken you to get there if not for COVID. If we're trying to find silver linings through these difficult times, that it forced you to stick with the plan for 2 years, right? What other, usually you try something for 2 months, maybe, right? That's probably a long time, 2 weeks. And you say, it's not working, forget it. But you had to stick with it. You didn't have a choice. And that's the same thing, whether it's social media marketing or whatever it is, being consistent and sticking with it. It takes time to see results. But now you're starting to see kind of that domino effect of all of that work and targeted work that you did, and refining those Zoom meeting skills and listening skills. And now it's finally paying off.
I to your point, I think that COVID was really like a blessing in disguise for Mike. And I know COVID was a horrible thing for millions of people, but when it comes to strictly business and time that we have, as advisors, our time is extremely valuable to not only serve our clients, but to go out and find new prospective clients and kind of build a pipeline of referrals or, different leads that we can tap into to grow our business in the future. But to your point, like, how long would it have taken me to get to that point where now I'm sticking with doing Zoom meetings? I think it even goes one step further, is if I had to teach every single prospect what Zoom was and how to use Zoom, I really wouldn't, that's not scalable. But the fact that everybody had to learn Zoom because every company went remote, then everybody already has a base knowledge of what Zoom is, how to use it, how to log in. And I just say, hey, I'm using Zoom, this tool that you all just learned how to use, but now I'm going to be doing this exclusively. So I think that it kind of helped me because the learning curve for other folks was already there. I didn't have to teach people about what Zoom is, what WebEx is, or what these other softwares are that people, when I used to talk about this, and we did try this back in like 2017, 2018, and people were saying, whoa, how do you log in? Like, what's that? Can I download it at work? Those types of questions were very frequent. And I think that with people, once they understood the software and it became second nature to them, I say, like Zoom almost became like a verb. Like, I'm going to hop on the Zoom right now. Or did you do a Zoom yet with so-and-so? And once it was that popular, it made it super easy to transition to that full time.
I think too, what separates you from some other folks that are just starting off or in the first handful of years or 10 years of their building their business, is the ability to do some research on the client or prospect too. Right? Like most everybody has a online presence these days, right? Facebook, LinkedIn, Twitter, Instagram. Not many people on TikTok probably that we're talking to, but maybe some.
I wouldn't think there's any at this point. We're dealing with retirees.
But look, if you can go on Facebook, and it's not creepy. Look, everyone does this, right? But if you can go on Facebook and see that, Mary Smith, who you're going to be talking to next week, has a dog named Tootsie, for example. Maybe not say, "Hey, how's your dog Tootsie?" That's creepy. But do you have any pets? Right? It's an easy lead into the conversation around what probably they value, and then people love talking about themselves. We talked about last week that it releases feel good chemicals in your brain, and so it's an easy segue or an easy way to your point, to kick off a meeting by letting that person talk. And I think the other big thing that you do a really good job of is to take a lot of these folks are meeting you for the first time ever, and it's on a screen, right? And just by saying in the beginning of the meeting that, hey, look, there's no sales pitch at the end of this. There's nothing coming at the end where I'm gonna press you to move forward. This is to get to know you meeting. As important as it is for you to find a good financial advisor, I feel the same way about our clients. And that goes a long way. Kind of shoulder, you can actually see if they're on the video, the shoulders kind of drop like, oh, okay. Like there's not really there's no pressure at the end. I'm not gonna have to say no 25 times. And not only that, but mean it. Like there is no sales pitch. I don't know. We're trying to figure out if we're a good fit, and if we are, we can talk about next steps on a follow-up meeting. But let's figure out if there's, a fit first.
Yeah, I think I've definitely seen that time and time again, where people have this like sense of relief when they know what the meeting is, and that when you can kind of see what's coming at the end of the meeting and that there's no surprises, when you get out in front of it at the beginning, it does give people, I think, generally a more positive experience, because now they're actually listening to what you're saying and who you are and what your company does, rather than thinking we're getting closer and closer to where I'm going to have to say no or say yes or make a decision about. And really, it's not a small decision. It's when we're dealing with the finances of people, of assets they built up for the last 35 years in the working career, it's a big decision. So to put somebody on a spot, usually they have to talk to a spouse as well. So there's a lot that goes into it, and knowing that is strictly just getting to know each other, it does generally, at least I think, and I know you agree with this, is it tends to be a more positive experience for prospects.
Yeah, and we're in this weird business where we have people hire us, and then we have to earn their trust. It's kind of this backwards thing that goes on. And so I think being genuine, being a good listener and genuinely interested in what they have to say, I think following through on the planning process and the follow-up process and that sort of thing is really important. And I think caring about the person on the other side is important. Having genuine empathy with what they've gone through and what their goals are sets you apart. So all that stuff, the second part is stuff that you should already have implemented, right? To care, right, about other people. If you're doing this for the money, it's not going to last very long. I'll just be honest. You have to genuinely care about the other person that you're trying to help. And all the other things, those checkpoints that you made before, kind of get you there faster, I think. Yeah. So anyway, I think it was a really good article. I think it's going to be on our website next week, but that I would encourage folks to take a look at.